Time to get down to the brass tacks. My name is Mel Sams and I'm the Managing Associate of Sams CPA. And today we're going to talk about divorce and taxes. Divorce is always a challenging time for all parties involved and is an unfortunate reality for many people. With that said, emotional, family impacts aside, we want to make sure that we don't get caught with unforeseen and unwanted income tax effects. The first thing I want to talk about are the new alimony rules under the Tax Cuts and Jobs Act of 2018. Prior to 12/31/2018, we could deduct alimony that we paid to a former spouse, and that former spouse would have to include that alimony in their gross income. We received a deduction, they had to pay tax on it. However, those rules have changed. Effective 12/31/18, any divorces originating after that time, alimony is no longer deductible to the payor and is no longer considered income to the recipient. This is going to have a huge impact on people. Now, don't be alarmed if your divorce is already settled prior to that and you've been paying alimony. You're okay, you're grandfathered in under this new law. But any divorces that originate after that point in time, alimony is no longer deductible to the person paying it or the income of the person receiving it. Now, this is important because it is going to have a major effect on the settlement agreement that you negotiate or that your lawyer negotiates on your behalf in that divorce. Typically, we have been a little more likely to want to pay alimony because we get a deduction for it. But that's not going to be the case anymore. So you have to consider that when you're crafting that divorce settlement agreement. And if your attorney doesn't bring it up to you, mention it to them because they should know that. That's very important. And as always, consult your CPA in any major life changes, especially a divorce. Talk to your CPA first and foremost. They'll be able to give you the current rules and tell you how you're going to be affected by them. The next thing I'd like to talk about is what happens to a qualified retirement plan in a divorce. These days, many of us have 401ks and other qualified retirement accounts. What happens to them when we get divorced? You always hear about them being divided. You hear about them being marital property if that money was contributed or grew or deferred while you were married. Generally, that becomes part of the marital estate and becomes marital property. Now, different states have different rules on how property is divided. Some states are community property states where you go down the middle 50-50. Other states look at the lifestyle. There can be an unbalanced settlement depending on the lifestyle. But that's not the point. The point is, in a qualified plan, in a divorce, you will likely have what is called a quadro, a qualified domestic relations order. That is where the courts say that a 401k or other qualified account has to be divided between two people, between the person, the spouse who contributed the money and the spouse receiving the money. Now, the fact of having a quadro does not create a taxable event to you because the IRS has a specific exclusion for quadros. It doesn't trigger a taxable event whereby you're taking money out of your qualified account and you may have a 10% penalty and you have to pay income tax on that. The quadro is an exception to that rule. But what I've seen happen in the past is in a divorce, and these days where a lot of us have a lot of our wealth in qualified plans, that quadro takes place and a spouse suddenly gets part of a 401k account or some other qualified plan, and they begin taking money out of that to pay bills, to live, to pay their attorneys. And unbeknownst to them, they have a 10% penalty and have to pay income tax on the money they took out. Even though it came from your former spouse, that money has not yet been taxed. You're the one that took it out, you have to pay the tax. It's unfortunate, and a lot of times it catches people by surprise. So please be aware, in a situation with a quadro and a qualified plan, you need to talk to your CPA, and let me stop on that point for one moment. Typically, a husband and wife they have the same CPA. When they get divorced, a lot of times the CPA does not continue to do business with both spouses because of a conflict of interest. Some CPAs will ask the husband and wife if they want to continue working with the same CPA. Obviously, confidentiality in our firm is paramount, and we will typically continue to work with husband and wife if they're both in agreement that that's okay. But the point is, if you're the spouse who doesn't retain that CPA, you need to go find another CPA immediately. So you can refer to my other video about how to select a CPA. You need to watch that. But back to my point, your CPA can tell you what effect is going to happen to you if you take money out of that account. They can tell you how and when that can be done and what the consequences may be. Finally, the last thing, and this is an easy one, but a lot of people miss it. Check your allowances at work. Check your withholding. For those of you that are working and getting a W-2 and earning a salary, every year some people may not even realize they do it. You fill out that W-4 form and you tell them how many allowances, and you kind of go down and you do the addition. That's a very important form because you're telling your employer how much federal income tax to withhold on your behalf, and at the end of the year, that's what's reflected when you file your income taxes. What you don't want to have happen is withhold as married filing jointly for part of the year. You get divorced and you don't change that withholding allowance, and you continue withholding at that married filing joint rate, which is less than the single rate. And you get to the end of the year and you're hit with an unwelcome surprise that you now owe tax, and it was because not enough federal income tax was taken out of your paycheck. So be certain that upon that event of a divorce, you sit down with your CPA and you ask them, how much should I be withholding from my paycheck? How much money should I be paying in? Your CPA can tell you, he or she can tell you exactly how to update that W-4, where you should be, and they'll ensure that when you get to the end of the year, there's no surprises. If you have any questions, comments, or ideas for future videos, please let us know. If you'd like to be notified of future videos, please subscribe to our channel.